So in this video, I'm going to share how you can earn passive income by utilizing something known as dividend investing. So investing into dividend stocks, it's something that's been around for quite some time, but something that you can consider taking advantage of in order to earn some extra cash on a monthly basis. So we're going to dig into that in this video. Now, there's really two different ways of making passive income. We've mentioned this in the past before, so we won't touch on it too much, but essentially you're putting something up front to then reap the rewards of it later. And you can use time up front, which some people don't have, or you can put money up front to then earn money off of your money. This is how the rich stay rich. They invest money and then make money off of their money. Now, you don't have to have a lot in order to start with this. I started with literally $50 with dividend investing and have built it up over time. Now, when I started, I didn't have a mentor. I didn't have someone to show me how to do it, teach me how to do it, but I just used free resources online and various different books, dozens of books, to learn how to actually invest into dividend stocks and invest into various companies to then earn money from my money. So you can do this. Anybody can do this. It's very possible. So if you're new here to the channel, you want to learn more about investing or personal finance or building wealth, then consider hitting the subscribe button. We do our best to help as many people as possible learn as much as they can about building financial freedom. So let's get started with this video. Let's not beat around the bush. Let's just start with this. Now, what is a dividend? Let's kind of jump into that before we actually go into the details. I'm also going to share some mistakes that I made in the past when I first started as well. But let's talk about what a dividend actually is. So essentially, it's just going to be a payment that a company is going to give you for essentially owning that company's stock. That's the best way to think about it. It's almost like a little bonus or a cash payment that they're going to give you either on a quarterly basis, sometimes on a monthly basis, or even in some cases on an annual basis, depending on how they structure it. But they're going to be paying out in cash for really a bonus for you owning that company's stock. So I'll give you an example here of how this actually works and how you can take advantage of this. But why is it that some companies pay dividends and other companies don't? If you look at, say, PepsiCo, which I'll show you a little bit more in depth, but if we look at Pepsi, they're paying almost about a 3% annual dividend versus maybe if you look at Amazon or Facebook or Netflix, they don't pay dividends. So some companies pay these cash payments as dividends and others don't. And the reason for this is because one's generally in the tech sector or companies that believe that they can reinvest this money back into themselves a little bit better, generally won't pay out dividends, but rather just take the profits and put it back into R&D or various other things that they can then grow their business faster and hopefully grow their stock faster than dividend stocks that are generally more well established. You'll see them as blue chip stocks, companies that maybe have been around for quite some time, but like to pay out to attract new investors with that dividend. So let's take a look at PepsiCo just to give you an example here as to how you can actually take advantage of this and kind of go over some details here. But what I'm using here is just a free resource. You can use Yahoo Finance. It gives you a little bit of information about this company and a nice, decent understanding and an overview of this company. Now, you can also go onto the company's website, look at their Form 10K, look at their various other investor relations page. Just about every company that's traded on the stock market is going to have an investor relations or investor resources page on their website, and they're going to have a lot of information on there. So if you're ever considering investing into a company, just go onto their company's website and or just go onto Google and type in investor relations for Pepsi or investor relations for Coca-Cola. It'll bring you to the company's website, and that's where you'll be able to find a lot of information about that actual company and their earnings and their different financials, and we're going to go over some of that later on in this video as well. But let's take a look at Pepsi here to show you how you can actually take advantage of dividend investing. So for example here, so Pepsi, $132 per share for this particular stock. That means if you have $132 of your money invested into Pepsi, you could be earning about 2.98% as a dividend payment from that company. So about $3.82 in the course of a year as a cash payment to you, paid out on a quarterly basis. So split this $3.82 over 4 different quarters. So every 3 months, you'd be getting 1/4 of this $3.82. So this might not seem like a lot of money. You say, well, gee, $3.82, I can barely buy a cheeseburger at a store, at a fast food place. How is this worth it? Well, the key here is that you're building this up over time. And what you can do is maybe you only have 1 share of Pepsi for $130, but over time, if you had 10 shares or 100 shares, this could really add up, or even 1,000 shares. You could be making thousands of dollars per year in dividend payments that you can then use towards car payments or Netflix subscriptions or various other things that you want to spend money on. And it seems to be very sustainable over the long run. So what we can do here is, if we're using Yahoo Finance, go to the statistics right here, and then you can look a little bit more about their actual dividend and their other financial metrics that you can take a look at. But looking at their dividend, there's a couple things that you're going to want to be aware of. One of them is the payout ratio. This is a very important financial metric that you want to consider when looking at dividend stocks. And the payout ratio is essentially just going to be the dividends as a percentage of their earnings. So if you're seeing this number quite high, say over 100%, this could be somewhat of a red flag, showing that maybe this company isn't able to actually sustain those dividends that they're paying out. And this is what I really want to caution you on. See, when I mentioned that I started pretty young in the stock market, nobody was really showing me the way. So because of that, I made a lot of mistakes when I was younger. And one of them was that I was falling into dividend traps. And I don't want to see people do this for themselves. So essentially, dividend traps, what can happen is a company might have a very high dividend to attract investors, and then either slash that dividend as new investors come in, or just not be able to increase their stock price because they're paying out so much money in dividend payments that they're not able to reinvest back into their own business. So to give you an example here, when I started investing, I would look at companies, I would say, okay, well, Pepsi's paying a 3% annual dividend. And then I'd find another company that's paying a 6% dividend. And then I'd say, well, here's this other company that's paying a 12% annual dividend. This looks like such a good deal. And when something looks too good to be true, in a lot of cases it is. That's how it works in the investing world. When something just looks too good to be true, there could be something fishy behind the scenes that you might not fully realize at the moment. So if you're seeing companies that are paying out very high dividends, you want to look at the payout ratio. You want to look at their history of paying dividends as well as their stock price, because something else you want to consider is you want to look at this company's dividends over their lifetime, but also their stock price, and factor those two into the equation. To give you an example here, say that we have company 1 here and versus company 2. Right? Now, company 1 pays out a 6% annual dividend, but their company stock is losing 4% per year over the past 10 years. Well, your total gain on that might only be about 2% per year because you're getting a high dividend, but the company's not growing. It's actually declining. So that's actually not that great versus maybe another company that's paying out a 3% dividend, but growing at a 4% rate. So you could be earning 7% on that one with a smaller dividend, but a company stock that's actually increasing. So that's a great example for something like Pepsi. They've been increasing over the long run. Same for Coca-Cola. Been increasing their dividends as well as increasing their stock price in the long run, which is something you would definitely want to consider. So don't just look at the dividend. I sort of think of a dividend payment as really a cherry on top. It's not the first thing you want to look at, but certainly something that you do want to factor into the equation as to whether you're going to invest into that company or not invest into that particular company. Now, there are a number of different financial metrics that are going to be incredibly important when looking at dividend stocks, one of them being the price to earnings ratio. This is especially important for people who are investing into those blue chip stocks, or those stocks that aren't necessarily high, fast growth, but more so well-established companies. So the price to earnings ratio, PE ratio, you're going to have to take very close account into that. And then also looking at the earnings per share. So how much money is this company actually bringing in per share? What are the earnings on that? And another one that you're going to want to heavily consider. Now, as I mentioned earlier, look, you can learn so much free information on the internet, on websites like Investopedia, which I have used heavily in the past, as well as just reading free books from your local library. Now, I will leave some links to some different books down below, some of the best books that I've read on investing to help you build a nice knowledge base for yourself. But like I said, you can get these at your local library, or you can pick them up for probably $8 or $10 off of Amazon, and then read and really learn a lot about investing. And really the key here is to think about the long term rather than the short term. Now, one of the benefits to long-term investing with dividend stocks is that you're actually going to have a lot of tax benefits off of it as well. So I'm not an accountant, so you're going to have to consult your own CPA or accountant here, but essentially with dividend payments, a lot of them, unless there's certain types such as REITs, I believe, but with a lot of dividend payments, they're actually seen as long-term capital gains. So the most you could be taxed on it is about 20% in the United States, anywhere from 0 to 20%, versus regular income tax, which could be up to almost 40% annually on those income taxes through your regular job. So capital gains tax, long-term capital gains tax, is another reason why a lot of the rich people are paying less in taxes. This is why Warren Buffett, famous quote, says that he pays less in taxes as a percentage of his income than his secretary had. So really interesting, he has billions of dollars and he's paying less in taxes. The reason for it is because he's taking advantage of some things like long-term capital gains, which is especially nice for dividend payments. So how much money can you actually make with dividend investing. Is this actually something that's sustainable, and is this something that you can become rich off of? And what I want you to think about here is, let's say that you're earning 3% annually from your dividend payments, as well as maybe some stock growth over the time. Maybe say 3% stock growth, but we'll not factor that into the equation. We're talking about cash coming into your pocket. Now, if you're starting with $50 like myself, over the course of a year, your dividend payments, you might get $1. You might be able to go to McDonald's and find something on the dollar menu and maybe get it with that dividend payment. But if you can build this up over time, say you can build this up to $100,000. Well, $100,000, 3% annually would be about $3,000, which I believe is about $250 a month. I don't know if I did that math right in my head, but about $250 a month in cash coming into your pocket that you can then use on various expenses. And what's interesting about this is that it's in many cases seen as quite sustainable. So assuming that you are diversified throughout your portfolio, you have various different companies, and you're not putting all of your eggs in one basket in one company, this could be something that could be very sustainable over the long term. So I do want to leave a word of caution because, as I say, it could be very sustainable, but there are times where the market declines. We'll see recessions. We could have a depression. There are times of hard economic times that you want to be very careful of and think about before actually putting any money into investments. There are risks, and you need to be aware of that. But what I personally do is I reinvest the dividends that I get from these companies back into these companies or various other different types of investments. And I think this is really the key to finding success over the long term. Instead of taking those dividend payments and spending them on your mortgage or spending them on car payments, actually just reinvesting them back into various other companies or various other different types of investments. And that is how you can build wealth over the long term. Look, dividend investing, passive income through dividends, it's definitely a long-term game. It's not something you jump into and get out of in a couple weeks and make a lot of money. It's not going to make you a millionaire overnight, but it's something that could potentially make you a millionaire over your lifetime. And it's something that has been proven by millions of people have done this, and they've done very well with it. So it's something that you want to consider doing. So what if you personally don't feel as though you want to invest in individual companies or go through the process of analyzing a company and looking at their financial statements and their income statement and statement of cash flows and looking at their balance sheet and calculating different financial ratios? If you don't want to do that, there are other options out there that could have various risks, but also could be beneficial. And something like that could be index funds or ETFs that can essentially track certain types of dividend stocks. So a good example of this would be something like a Vanguard high yield dividend fund. So I believe the expense ratio on this is about 0.09%. So it's a very low fee to get into this. And Vanguard, very reputable company. We've talked about them before on this channel. I'm not associated with them, but they manage trillions of dollars worth of assets for lots and lots of clients. So Vanguard essentially sets up these ETFs or these exchange-traded funds that will sort of capture many different dividend stocks within their portfolio. So if you don't want to invest into one company or just a couple of different companies, you consider putting some money into an index fund, or sorry, an ETF that you can then hopefully do well over time. I believe their average dividend is close to about 3% for those different dividend stocks. That gives you a nice basket of different stocks that you can get into without having too much experience in the markets. So those are some different ideas for yourself. Look, if you want to learn more about investing or personal finance or building wealth, consider hitting that subscribe button. Really would appreciate it. If you found value in this video, drop a like, and I'll see everybody in the next video.